Welcome to today's session of Unleashing Potential. And with me today, I have a very interesting person by the name of Brigid McCleary. Now, Brigid, welcome. It's great to have you here today.
Thanks for the invitation. I feel very honored.
Well, when it comes to financial matters, I mean, you are foremost in my mind in terms of really making a difference in the lives of other people. What is it about the financial world that just enthuses you and fires you up?
As you know, I come from a nursing background, and when I was nursing, I actually realized that you cannot separate finance from anything else. It's part of your life, and a lot of people, didn't get the care that they needed because of finance. So going into the financial fields, I love to see people flourish. I love to see them grow, and I love to see them to get not just what they need, but everything they want. That would be my dream.
Wonderful. Well, like I say, money makes the world go around. But the thing is, where people actually direct their money, it even goes around even better. Well, I know that your philosophy about wealth sort of lies in the name of the company that you represent, which is dynamic wealth. Is that correct?
Designed wealth.
Designed wealth. Okay, designed. It is dynamic of per se, I tell you, but it's designed to bring wealth to other people. So I know that there are three key words that sort of stand out when you look at it. What are those three key words?
So usually it's service.
Yes,
Oh, I've got to actually look at myself. It's advice, service, and relationship.
service and relationship. Okay, because I know that when it comes to people, you guys are always highly service orientated, but to continue with that relationship as you add value to the person. And that's why, as you design it, I take it the word of inner self says is to design it around the needs of that individual, not of what you think or feel.
That's correct. We're all individuals, and you can't just make a plan and make it stick to whatever. Just like everyone, I mean, even wealth means different things to different people. So our lives are so different. We have different needs, different wants. Everything is different.
No,
And
that
that's
is what
what makes it such
that
fun.
is that. Then again, to hear somebody in the financial world saying that it is fun, I mean, other people go, "What are you smoking?" I mean, when it comes to money, they just want to cry. But then again, that's why we need people like you, Bridget, because you are from the onset, having been a nurse, you've got that caring side in you, but you wanted to add more value, and therefore you studied and got yourself into a place where you are now a representative, and you want to add value to people in terms of guiding them and leading them financially, in terms of being set up for a better, stable financial life. So if you meet a person, be the age 25 or 35 or 45, is the approach the same or what is your approach?
My approach is always the same, and that is to start where you are. Always
Okay.
look at where you are and how did you get there. So I also look at the psychology behind how you got there before I even go into the plan, because if I can understand what's holding you back up to this point, then I can try and get you to think differently so that when you move forward, those same things don't keep holding you back, that you start looking at things differently. I can make the most beautiful financial plan for somebody, but if I don't understand their way of thinking, I may as well waste that time on something else. It's not going to work.
Well, I'm going to have to agree with you because you see, I think I heard as a child all the time, money doesn't grow in trees. And that sort of was my approach to life. And as a young businessman, I know I was a manager at the age of 22. So I started in the business world quite young. And then one day it dawned on me, hold on, we were actually running a race from Watervalboven to Nelspruit past a place called Ngudwana. And there was a paper factory in Ngudwana, a smelly place. And then it hit me. Money does go in trees because they took the pulp, they took trees, cut them down, and that pulp produced paper. And I went, hold on, money does grow in trees. And it sort of started changing my mindset a bit because my dad, my mom, always said, there's not enough money. Yet we planned to go and leave every year. We had a great life, and they did the best they could. but it sort of influenced my thinking until that day when I said, money does grow in trees. And I sort of started relaxing and opening my mind a little bit more. What do you find with
And
other people,
so, what do I find with them?
with other people's thinking, their point of departure? Is every person different?
Every single person is different, and sometimes even that money grows on trees, it might mean something very different. So it's how you interpret that money grows on trees. Is it, do you interpret it as a lack of, or like you say, when you realize that money does grow on trees, suddenly you see it from a different angle and you think, actually, if money grows on trees, there are a lot of trees. So money is in abundance, but it's about how you open yourself to access that money and to use what's available to you to get more money instead of hiding it under the mattress where it's probably going to be stolen by somebody anyway.
I do think that the age that you're in sort of plays a role in your life, because when you are in your younger ages, it's like you're unbreakable. I mean, you just spend your money because you believe that you've got the energy and tomorrow there's going to be money, but a bit of a non-planned approach, but you cope. And then all of a sudden you get to we now have children, now you're married, like, oh my gosh, now you have this needy part of you says you never have enough money. And the thing is, that is the very time that you should be planning for your future. I did one thing right, and that is when I was 17, just before no, no, I just left school. I took out the little policy that said to me, if I paid 17 Rand and 13 cents for the rest of my life, by the time I'm 44, I'll be a multimillionaire. I believed that. And I paid that 17 Rand and 30 cents policy all the years. However, it was not linked to inflation. Hmm. It did not even come close to me being a millionaire when I got to 44. So I had to learn the vital lesson in terms of although it was sold to me as you only have to have this one investment. Now those years, 17 Rand was like a lot of money. I mean, you know what I mean? I was a youngster and I really felt that was a big chunk out of my money and I had to work hard to pay it on a monthly basis. But I forgot about inflation. Nobody said to me, you need to keep abreast as to what's happening in the financial markets. But the thinking was then that is that I need to put some money away. So that sort of now it follows you because I think behavior plays a big role in the patterns of how people either manage their finance or not manage their finance. And so it
Correct.
happened in my own life where I have my ups and I've had my downs. But the reason why you're on today is because when I sat speaking to you, I just heard such wisdom in terms of it's never too late. And I went, what? I mean, it's no secret. I'm 65 this year, and yet speaking to you, I got that message. It's never too late. It actually starts planning towards having a better financial future. So, what is your take on a person's age? It doesn't matter to you. You will help them wherever they are.
We start now. Now is a good time to start. Tomorrow's too late, and and yesterday is never going to come back. So today is a good day. Now's the right time. But also, I think when people have that mindset when something's too late,
Hmm.
it's like giving up in life. It's like stopping growing. And when you stop growing, you're dying because you're not keeping up with the times. You're actually going backwards. So if you can always believe it's never too late, whether it's to study, to save, to do something you've never done before, I don't believe in too late. I believe in starting now and saying, right, by this time I'm going to do it. And
Well,
I'm going to make the changes that will let me do that.
I happen to be in the company of good people. That is, my own wife got her PhD at the age of 50, 50. I mean, that's something to celebrate. I mean, you don't hear of people at the age of 50 still studying and going to get a doctorate, but she did. And that
Well,
sort of became a mindset of nothing is too late. We can accomplish that. Now, the reason why you're on this call is because I find your input so valuable in terms of what are the different ways for us to get ahead financially. And I'm particularly interested in what I call the investment summary vehicle. There's a summary of things that we can do. Those are vehicles will take us across. And the first one that you spoke to me about was it's not too late. to have a retirement annuity, although you are what we call beyond retirement age in a sense. And I went, why? So talk to us about that. That to me is very interesting.
I like retirement annuities because you get that tax rebate at the beginning.
Hmm.
All your growth in it is tax free. And when we look at people that are over 55, like yourself, if you had to draw that lump sum, the first 550,000 is tax free that you get out. Whereas if you withdraw from that when you are under the age of 55, if you withdraw that lump sum amount, that 1/3, it actually gets added to your income. So it can actually push you into a higher income bracket. So I always say to people, don't invest all your money in a retirement annuity. Rather invest a little bit maybe in a tax-free, even a little bit in money market to create your emergency fund. So look at what your needs are, your short-term, medium and long-term needs, and then first of all choose the right type of investment to do the job, and then also looking at the assets. So that would be like whether to invest in money market, bonds, property, or equity, which is basically businesses that you're investing in. Diversify it and link the assets as well to the time that you need to, when you're going to need that money. It needs to be available, and you need to look at the tax implications when you take that money out.
You remind me of, if I look at the tree behind me, when is the best time to plant a tree? Yesterday. Where's the second best time to plant it? Today.
Right now.
And that is right. And this is really what I would like to encourage people is to listen to you today and to say it's never too late for you to reshape your financial future because it's designed well. It's designed around you. I mean, because I know that you look at every person individually, look at their circumstances, look at their ages, look at how many years expectancy there is in terms of healthy, but also what about the times where you might not be that healthy, and then obviously would be a different game plan. But let's start with so retirement annuities absolutely is a great investment vehicle because why? It gives you the third lump sum that you can get at, and that is tax free. Is that right?
Up to 550,000.
Up to 550,000.
And then it goes according. So the lump sum tax table is slightly different to your income tax table.
Okay.
So you get that 550,000, which is tax free.
Hmm.
If the lump sum is, so if you've got a large amount in your retirement annuity and you withdraw more than that 550,000, then it goes onto that different tax table, and it's slightly less than if it was added to your income tax
Okay.
table, the income tax table.
But
But the nice thing as well is if you say you pass away and you've got dependents,
yes.
that that money in your retirement annuity doesn't go through your estate. It goes directly to your dependents, and the
Then
trust that governs the retirement annuity fund, they will make sure that those dependents get that money. So there's no estate duties, there's no executors fees. Everything goes directly to those dependents.
But that's a very big advantage. I mean, of course, I've heard of so many people that when their parents pass away, that everything is now held in this estate, and they have to wait for how long, and there's estate duties, etc. I know the first, I think, 3.5 million is not bound by estate duties, and thereafter it is. However, and I don't know many people that really have got assets of communication or accumulation beyond that figure. Because I mean, I find that people mostly today are living from hand to mouth, and they're really trying to make it and invest in themselves to have a better, can I call it senior ages? How many parents do you know that are living with their children? Why? Well, they didn't keep track of inflation. Didn't keep track of how old they're going to be, etc. So you would do that study around the unique individual and said, even if you are 65, a retirement annuity can still serve you well. That is one portfolio. Then I heard you mention tax-free. So talk to me about the tax-free vehicle.
My favorite investment.
Yeah.
I think everyone should have a tax-free policy. It is quite governed, so the money you put into a tax-free is not tax deductible.
Okay.
So you put the money into it. You can only put 36,000 Rand per tax year into a tax-free policy. And then over your lifetime, you may not put more than 500,000 Rand throughout your life. But
Okay.
the growth on those policies, because there's no tax within the policy and it pays out tax-free, that is such a big benefit. Because if you, I always say to people, don't use a tax free as a policy where you're going to take out emergency funds or anything like that. See it as long term growth. Try and maximize the amount you put in until you reach that deadline of 500,000. It'll take you about 13 and a half years, but invest it fairly aggressively, even if
Okay.
it's slightly more aggressive than you would your other investments, but leave it in there so that when you need to reach a point where you have to pay off your house or whatever and retire, instead of taking that lump sum out of your retirement, you use your tax free to pay all those and you use the full amount in your retirement to give you a better income.
That sounds very wise. Now, obviously, if I look at my case, I mean, our four married children have moved on. They've got their own children. We've got 10 grandchildren. So now, obviously, the direct benefit of tax free would be my wife and myself because we're now living together. And then there should be a will in place that should we pass on or pass through, that that money will be purposed wherever. But that will have to be stipulated in the will, or how does that work?
Okay, so with a tax free policy, if you take a tax free out through the bank, for
Mhm.
instance, most of them don't allow you to put beneficiaries. So,
Okay.
in other words, the policy will the money in the policy will go through your estate. However, most of your insurance companies like Old Mutual, Sanlam, all of those, you can actually add beneficiaries to that, which means it doesn't go through the state.
Okay.
If your estate is very large and it's above that 3.5 million, then the person that has received the funds may have to pay in some estate duty of 20%. However, if you structure it correctly, that will go straight. So there's no executors fees or anything like that. And if your estate has enough liquidity within the other investments, you
Okay.
can actually put in your will that you don't want any of that estate duty to come from that policy because it's not an enormous policy. So if you have an estate over 3.5 million, that policy is going to be a small amount compared to the bigger picture. But a lot of people, when they plan their estates, it's all in property or assets. So now you've got to make it more liquid. So you've got to start selling things off to create that liquidity. And that's when they start looking at tax free policies and that type of thing. So even your estate, there's only two certain things in life. You're going to pay tax and you're going to die. So you may as well, when you plan, take those two things from start to finish and make sure that they apply to help you rather than fight against you.
That's actually very funny, but it's true. You might as well just plan for them. Okay, then, yeah, we spoke about retirement annuity, we spoke about tax free. I know there's investments like unit trust. What is the benefit of having a unit trust, for instance, versus the tax free?
Okay, so I would always look at a tax free first, but because of the limitations on how much you can invest,
Hmm.
um, I then would look at any excess above that 36,000 in a tax free is taxed at 40%. So instead of putting it in the tax free, it's better to then look at a unit trust, and each asset within the unit trust has got different tax implications, which I won't go into detail because it's it's almost like a session all on its own.
Yes. So
Also
tax
a flexible
calculation.
side,
So
yeah,
any tax
but
calculation really is according to the person, the age, etc. Is that right?
correct, and also the assets that you've invested in. And
Okay.
but the nice thing with a unit trust is it's very flexible. So now unit trust, you can then, if you're saving for a car in 2 years, you can have a portion of it invested in maybe a money market and a cash within that unit trust. So you're not always disinvesting your longer term assets like your property and your equity. Those will carry on growing until you need the next car or whatever else you need.
Well, let's talk
So
about
it's a
property,
very flexible policy.
because
Sorry?
the market sometimes think incorrectly that a property is an asset, but it actually is not an asset unless it's actually helping you make money. Like if you've got a flatlet and you rent that out and it's bringing you income, then it's an asset. But generally speaking, your property is a liability. But when you die, that property has value. Okay. If if it has realized its value, and that means it's now worth more than what you paid for it originally, it now truly is an asset. But what if you still own that property? It's called debt, right?
If it's your home, it's more a lifestyle asset than an income asset. It can become an income asset, like you say, if you rent out the granny flat or whatever. But a lot of people make the mistake of thinking that if they take out a bond and they maximize that 30%, which is what the banks look at, so they'll take your salary and they'll say, okay, you can afford 30% of that to pay towards a bond. But they misjudge what it costs to own a house, because it's not just about paying the bond, it's also about paying the insurance, it's about maintenance. There might be taxes, like you might live in a complex and there's levies and also those all come into play. So if you take out a bond for 25 years, by the time you've actually paid off that bond, what the home is worth and what you pay double what the home is worth. So I like to rather say, if you want the security of owning your own house and you fairly young, I would say instead of taking out that bond, rent for at least 10 years. But you have to be disciplined in saving the difference between
Okay.
your rent and that the rest of the 30%. You've got to save it for at least 10 years, more if possible, until you reach the point where you can pay for a property cash.
Okay,
Then
that's
you're
very
getting
wise.
value.
Very wise. But not many people do that.
Very few people do it because people want instant gratification. But if they delay that instant gratification for 10, the longer you save that money, the
Mm.
bigger the house you can buy, and you'll probably have left over to pay for the maintenance and maybe put some away for your retirement. Whereas if you go into a bond, really, you actually throwing money away, you're giving it away. With
Okay,
it,
but
when you start paying interest, you're actually paying more than that property is worth at the end of the day if you take it over 20 or 25 years.
so what I'm hearing you say is it has to do with a calculation. Now, if you only allowed 30% of your income towards the home as an asset, and the person decides, okay, I'm going to rent. So you would say take the difference between the 30% in rand value and what you're paying rental wise, and take that differential and put that on an investment. And then you say, these are the different kinds. It could be unit trust, it could be saving, or whatever. And you would then advise them how to purpose that money to make money for them faster.
Correct. If you look at property growth over the last, since I would say 2012,
Hmm.
properties haven't actually been doing very well. If you get a 5% growth per annum over that period, you've actually done well. A lot of properties have actually devalued.
Yeah.
Um, so now, when you reach the point where maybe you want to downgrade, so say you're in a big family home and you want to downgrade, you're not going to get the true worth of that property when you sell it. However, when you look at an investment and you put it high into equities, you are getting growth from Monday to Friday. You're getting dividends that are feeding that investment and buying you more shares. And even though the share price varies, if over a long period of time, with that constant feeding, you there is no one property that will ever beat that equity market if it is a diversified equity in good assets. And I would go literally global. I wouldn't only invest in one particular type of uh, equity. I would literally spread it as far and wide as it can go, so that if one little thing goes under, you're not going to feel it.
So I'm hearing two things from you, and I'd like you just to recap on that. One, it's not like time is your friend. That the more time you have, the more time you have to actually plan for your financial future. Am I correct in saying that one? That's first. Okay.
Time is your friend.
Time is your
Inflation's
friend.
your tax is your enemy.
Tax is your enemy.
Emotion.
But then again, gift to Caesar was due to Caesar. You're gonna have to pay your taxes, okay? But there are obviously tax smart ways to be tax wise. I mean, you don't have to be unwise. For instance, I know that if you happen to have a business, that your business tax is 28%, but your personal taxes will be, say, for instance, 45%. And you don't have to take your entire income and literally decide what you will reflect and what your taxable income. But you just have to be truthful to your situation. Is that true?
That's correct. You also, a lot of people, they are so conscious of what they're paying in tax
Yeah.
that they plan incorrectly. Tax must be part of your planning, but it mustn't be the number one thing that governs what you do. Because you can make bad decisions because you're trying to avoid tax. So, for instance, you be in a business, you want your overheads high so you don't have to pay tax. Well, you're kind of defeating the object because if you're paying tax, it means you're doing well. So you've got
Ah,
to weigh up the pros and cons. Don't spend for the sake of saving tax. That is just stupid.
okay.
You've got to look at it realistically, where you're planning first is how am I going to get to where I want to go and what my objective is. But what is the best and the most tax efficient way to get there? So it shouldn't be what is the most tax efficient and then I need to get there.
Okay. Well,
If you understand the difference.
let's talk about, as we start winding down, the tailor-make solution to any person sitting in front of you. What are the considerations that, or the things that you look at to be of best service to the individual?
So can you just repeat that question? I missed the first part.
I'd like to know, a person sitting in front of you, what would be the best approach for you to say, I'm not going to look at your financial situation? What thought process do you go through and what do you do?
My first thing is to literally listen. I will ask leading questions because the more questions I ask,
Mhm.
the more I get to understand not only the psychology of how they got there, how they manage their money, but I also get to know what's important to them. Their dreams, their aspirations, their goals. Before they've even made a list of their goals, I've actually mentally already put things in perspective of what is important to this person. Then I look at what they already have and what is available to them. I also then look at what can stop them getting where they want to go. So it's all fine investing, but if they lose their job, have they got enough money to live off before then? So now I'm looking at risk products because you can be healthy today and have a stroke tomorrow or be in a car accident, and it can stop you earning that income. Does that mean you have to stop living and your dreams come to a stop? Not if you've
True.
planned correctly. Because
Okay.
investments take time. You need to bridge the gap. And the way to bridge the psychological and the financial gap is through budgeting.
Okay.
Budgeting and planning correctly.
Now, when somebody sits with you, let's understand the process. Do they sit with you once or just sort of give me a little snapshot of, I'm here today, I'm saying, you know what, Bridget, take me on a journey. And how long will it take for me from sitting with you the first time to us having all our ducks in a row and having our investments done? Talk to me about that process as we start winding down.
So again, like I say, the first thing is to know all the basics. So that first session, I've got to get all the basics. Then, depending on what they can afford, we might have to do it in stages. So, one person I might be able to sit down, do a plan, and they will follow that plan from start to finish. They've got the means and they're able to do that. Most people I sit with, it's a process. So, we put one thing in place, we get things going nicely, and then we have another meeting. So, it's almost like a living plan. You cannot do one plan because things change. Kids leave home, they grow up, or you have children. Your health might change. You might change jobs and get a different salary or whatever. So these are all things. I can't sit with somebody and say, right, this is a done deal. That's what you need to do. My job's done. Uh, Cheers. So it's an ongoing relationship with my clients. There's no one or two or six. It's usually a process depending on what's available and how we're going to put that plan into action.
So once you've done the call it pre-assessment, now you've done the full assessment and you've put the plan in action, it's now all running. How often do you review just to stay abreast of circumstances and in terms of catering to the need of that client?
Okay. Well, I review at least once a year, but if I'm working with somebody that is doing it in stages, sometimes I'll see that person every 3 months, every 6 months, until we reach that point where it's now just a matter of controlling it. But then I like my clients to have me on speed dial. So if anything changes in their life, I hope that I will be the first person they phone. So
Wow,
I
wow. I
can
mean,
say,
that's,
right now we need to change the plan a little bit because we need to cater for that change.
well, that's the maturity of having been in the business. But again, it comes back to that filter, the ambit. You used to be a nurse. You've got that caring, nurturing mind. You've got this heart of saying, I want to actually help people solidify their futures and I want to care for you. So thank you that today I could speak to you, Brigid, about designed wealth. And that's designing that pattern around any person. And if they want to get hold of you, uh, where can they email you? How do they get hold of you?
So my email is pretty simple. It's just Brigid at designedwealth.co.za.
And how do you spell that,
And it's
Brigid?
easy to email me. It's Brigid
That's why I asked because
at
it's a
design.
different Brigid. I remember that one.
It's the Irish version, but
Oh,
I'm not
lovely.
Irish.
Listen, I just want to thank you so much for your time and just your candidness and openness. And I will be sending the details to the people. But I want to say if you want to reshape your life, you want to have a designed wealth approach in terms of your future, there's only one person I can recommend, and that is Brigid McCLeary. And she'll be available to you as you listen to this. Take that first step, be responsible, contact her, and make sure that you get an opinion that could change your life. This is Doc Ann saying thank you to Brigid McCleary and saying, remember, unleash your full potential.